Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. Last week I said that there were three major patterns developing here in recent times. Firstly, there was the possible early February to date bearish halfway hesitation. This has a potential target in the 192 even area. The next pattern was indicative of the then bearish state of the market, and gave the bearish angle of attack at the time of this market. It was a mid-February to mid-April bearish Andrews pitchfork. The third pattern was still in construction. It is a mid-November 2021 to date head and shoulders top, with a neckline acting as a backup support last week. The neckline, currently at 20085, is the nearest to the current market and indicative that indicate that this proposed head and shoulders top was almost done in its construction. So what could we then expect next? I said last week, and I quote, well, it very much depended if prices can drop down through the November 2014 high at 201.35, because then we can look at additional possibilities on the downside and not just target X below, end of quote. The top sign at the time was capped by the flat long moving average, is currently 218.60, and the 50% Fibonacci of the August 2021 to February 2022 move at 217.45. I added as a final note, and I quote, that should prices punch up and maintain these levels over these, then the bearish halfway hesitation, as well as the head and shoulders top, and even the bearish Andrews pitchfork, will all cease to be the primary drivers of this market, and something else will have to take its place. End of quote. Well, something else may very well need to take its place, as last Wednesday we had a large bullish opening white Mariposa that closed over both the 50% Fibonacci line at 217.45 and the long moving average. However, this move was tempered for the rest of last week as prices subsided back below the 50% Fibonacci line and the long moving average, but not closing below the broken upper time, currently 211.40, of the February to April bearish Andrews pitchfork. Then today, we've had another almost identical large bullish opening white Mariposa that utilized the support of the broken upper time and smashed up through both the long moving average, the 50% Fibonacci line, the short medium moving average, currently at 222.30, as well as piercing the upper time of the bearish shift pitchfork, currently 225.25, for the same February to April move as the bearish Andrews pitchforks earlier I mentioned. Now, while we haven't had consecutive multiple closes up here, it does place on notice that the possible bearish halfway hesitation and the bearish Andrews pitchfork may no longer be viable, and that something else may need to take their places. Indeed, it will only by grit, determination, and a good deal of luck that the big head and shoulders top pattern will survive this as a topping pattern. It may well end up being a continuation pattern. So, we'll see. London coffee. The key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 2021 rather than when New York had it, which was in early February 2022. This difference has been crucial to the early formation of a pattern here in the London contract, much earlier compared to the New York contract. We have a November 2021 to February 2022 head and shoulders top. Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline is currently at 21.23, and the market, which had broken down through it back in March, ended up having some difficulty since then in penetrating the support below that stretches from 20.04 all the way down to the secondary target X in the 19.35 area. Nevertheless, last week prices had another go on the downside, making a new low not seen since August 2021. Yet that achievement should be taken with a pinch of salt, as it was only a little lower compared to the low in early March. Nevertheless, it is worth noting that the primary target for this head and shoulders top had been achieved some while ago, and it was a secondary target that was still left. And as I have often pointed out, secondary targets are harder to achieve. Finally, I pointed out the newly drawn mid-February to early May bearish Andrews pitchfork. It is still early to say if this pattern will work, but it is still there. The market is currently in between the middle tine, currently at 1924, and the upper tine, currently at 2120. Given what's happened in New York, I've decided this week to also draw on here the bearish shift pitchfork for the same move, just in case. The market is in between the middle tine below, currently 2022, and the upper tine above, currently 2144. The final pattern I pointed out last week was the possible late February today bearish halfway hesitation. To be honest, this one has had so many false starts that I am treating this latest effort with another huge pinch of salt. However, if prices do manage to make their way down through the congestion between 2004 to 1935, which as we can see is no easy task, then a target X1 for this bearish halfway hesitation would be in the 1895 area, right off the bottom of my daily chart. Thank you for listening. This weekly broadcast gives essential patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. And here comes the final bit.